The past few years have been an adventure for everyone and everything, including investments. Even though crypto wasn't the only place you could have either made or lost millions of dollars, it might have been the most popular. Crypto has been around for a while, and we aren't really here to look at the history of it. My personal belief, without knowing too much about the industry, is that we are probably in the tech bubble burst stage on the timeline, where the future is bright and promising, but currently is an extremely oversaturated and risky market. Instead, what is really interesting about cryptocurrencies recently is the amount of support they have received from all different avenues, but specifically businesses. Governments, politicians, billionaire investors, and financial institutions all seem to hop on board and have a view on the matter, but others saw this as an opportunity to pioneer a new world, and they weren't going to miss the boat. Unfortunately, they might have wished that they had just decided to sleep in instead. Before we get into the first U.S. crypto bankruptcy ever filed, we do have a little historical context to look at. The first ever crypto bankruptcy occurred in 2014 when the Tokyo-based crypto exchange Mt. Gox shut its doors for good. It had been successful in operating since 2010 and at its peak accounted for 70% of the Bitcoin transactions. However, after being hacked, maintaining weak network protocols, and other technical issues leading to the lack of accounting details, Mt. Gox was unable to locate over 600,000 bitcoins and file for bankruptcy. A legal settlement regarding repayment of funds to its creditors was not reached until 2021. Next up is QuadrigaCX, which was Canada's largest crypto exchange. Beginning in 2013, the exchange slowly increased in value over time, but in the 2017 crypto boom, the company's accounting and transaction systems could not keep up with the increase in volume. In 2014, they reported a mystical loss of 13 million Canadian dollars due to a smart contract error. Then, in 2018, the death of the sole leader of the company led to a disaster. Most of Quadriga's crypto was held in cold wallets, which were only accessible by a dead man. Eventually, the company was able to get back some of the funds, but they turned off their license in January of 2019, and they haven't been turned on since. Then there is New Zealand crypto exchange Cryptopia, which formed back in 2014. By 2018, over 2 million people were using the exchange. But we can see a pattern of these older giants, and with poor infrastructure, hacks, and even having issues following anti-money laundering laws, Cryptopia chose to liquidate in May of 2019. Its debt was just north of $4 million, but even after a claims process started in 2020, it is still unclear how much has been paid back to its creditors. Lastly is Cred, the first U.S. crypto bankruptcy. The lending company started in 2018 and was originally founded in Singapore before transferring to the United States. They offer investors interest rates of around 4 to 10% to people in over 140 countries. But trouble began for the company when Bitcoin began to spike in 2020, which was raising their liabilities. That, along with security issues, freezing of customer accounts, an inability to receive debt payments, and the theft from a company manager of 800 Bitcoins, all led to Cred throwing in the towel and filing for Chapter 11 bankruptcy in November 2020, with an average estimate of $75 million in assets and $250 million in liabilities. As we now know, none of these companies were around during the entirety of the last crypto boom, so it should not be surprising if we lose some more during this current bear market. And those cracks definitely show. It could still be a little unclear on what exactly should be done in and with the crypto market, but more and more people are probably thinking that something needs to be done, a thought that can be evasive during bull markets. The current downfall of crypto companies probably started with the bear market and picked up pace with the crash of the stablecoin tariff and the company's exposure to those assets. But I don't think that is the problem. Every investor deep down knows that there is no such thing as a guaranteed return, no matter how sweet the deal may sound. The same can be said for crypto investments. You have to weigh your risk and your rewards and be willing to deal with the outcome. The current issue in the crypto market, especially in the lending and investing side, is that the companies for the most part work and operate like banks do. Now that part is fine. What is not fine is the fact that there are a lot of gray area in how they operate. Banks are required to maintain a certain percentage of assets to liabilities, has strict guidelines on who it lends money to, and tight interest rates and investment opportunities. Crypto lenders and investors have none of that. They also typically lend to other crypto companies, which connects them together, similar to the crypto market as a whole. So in bull markets, everyone is on a yacht sipping champagne, and in bear markets, everyone is looking for a cave to hide in. This brings us to today's setting, where the bear market currently has complete control. Things seem to be fine if you ignore the fact that the crypto market has already lost $2 trillion in value, but no major issues have occurred. That was until July of 2022. Three Arrows, also known as 3AC, is a hedge fund out of Singapore that was founded in 2012. The fact that they managed to stay afloat for a decade does support their legitimacy as a company, and at one point they were in charge of $10 billion in assets. But things are different now. After struggling with managing their losses from positions in and with Terra, Luna, Lido Staked Ether, and the Grayscale Bitcoin Trust, the company filed for Chapter 15 bankruptcy on July 1st, which prevents creditors from tying up assets in the United States. But it gets worse. Before the filing, the British Virgin Islands demanded the fund to liquidate in order to pay back its debts. Then, after the filing, Singapore's financial regulator had accused the fund of exceeding its assets threshold and providing false information. Global advisory firm Teneo was hired to help manage the liquidation process, but it is still unsure what the value of the company's assets and liabilities actually are. No clarity has come, as the founders did not speak or show their face during their introductory Zoom call for the bankruptcy. Their office building has apparently been vacant since June, access to financial documents and accounts has yet to be given, and the whereabouts of the founders is currently unknown ahead of their next hearing. But one thing is certain. Three Arrows' biggest liability was also someone else's. Voyager is a public crypto broker listed on the Toronto Stock Exchange that started up in 2017 and reached over 3.5 million users and almost $6 billion in assets. It offered interest rates up to 12%, allowed crypto trading, partnered with MasterCard on a debit card that was backed by the USDC stablecoin with a 9% annual interest rate, and marketed that all the US dollar deposits were protected by the Federal Deposit Insurance Corporation, the US government agency that backs depositors in American banks. Things were looking strong for the company as long as their clients were paying off their debt. But then trouble struck. On July 1st, Voyager froze customer accounts and a few days later filed for Chapter 11 bankruptcy in hopes to possibly be able to reorganize. So what happened? Well, during 3AC's struggle, they had become Voyager's biggest debt holder at $650 million. With their bankruptcy, Voyager has hopes to be able to pay off its creditors, but things don't look great. And they are not the only ones in bad shape. Celsius started its crypto lending journey in New Jersey in 2017, offering both retail and institutional investors opportunities at high-yield savings accounts. However, after failure to get debt repayments from various companies, not being able to lower their costs, losing $350 million in investments with crypto asset manager KeyFi, the lender had to freeze accounts and lower withdrawal limits this June. It was not able to hold on and filed for Chapter 11 bankruptcy in July. Celsius currently holds around $4 billion in assets and $5 billion in liabilities. To make matters worse, Celsius had a crypto token of their own. Its peak price topped out right around $8 with a market cap of $1.9 billion, but it currently sits at a token price under $1 with a market cap under $200 million. Some have complained of Celsius as being a Ponzi scheme. Others say that their customer deposits were not actually backed by anything, and the company has remained relatively quiet overall. It was able to pay off almost $1 billion in debt, so there is a slim chance it survives, but that could also just be because it was about to file for bankruptcy. The darkness may have ended, but the trouble certainly hasn't. Plenty of other crypto and finance lenders, big and small, may still have major issues right around the corner, some losing hundreds of millions of dollars in 2022. Blockchain.com alone could lose $270 million from loans to 3AC. BlockFi has had to take out a $400 million loan and lay off staff just to stay alive to this point. Singapore platform Vault halted withdrawals in July and has filed for insolvency protection. CoinFlex halted withdrawals in June after not receiving an $87 million debt payment. Concerns are also out there for companies and exchanges like Genesis, FTX, BitMEX, Babel, and KuCoin, all who have had negative exposure in the recent climate. The final chapter of this concurring story may be the most important, and it begins with a recent statement from Coinbase. In May of 2022, Coinbase Global announced in their earnings report that its customers that held cryptocurrency assets in custodial wallets could be considered the property of a bankruptcy estate if such an event were to occur. The crypto exchange added that customers who use its custodial wallets could be treated as general unsecured creditors. When it comes to Chapter 11 bankruptcy proceedings, unsecured creditors are typically the last to receive payouts. In this scenario, the smaller retail investor would only get refunded if there was any money after handling the business debt. Well, this is some bad news for us little guys. To clarify, because I myself was not really sure, when you invest in crypto or on an exchange such as Coinbase, you primarily have two ways of storing your tokens. Custodial, also referred to as hot wallets, are typically online wallets that a third party manages and controls. This would be like putting money into a Celsius savings account. Non-custodial, or cold wallets, have private keys and access and can be held in offline storage. It is harder for the bankrupt company to claim these coins as theirs because it is not in their direct possession. With everything that is going on, I highly recommend moving all of your crypto to cold wallets, if you haven't sold everything already. Who knows how the dice will roll? Some claim this is just the beginning, and others claim the end has already happened. What I do know is that millions of eyes will be tuned into the bankruptcy proceedings and the results, and I highly doubt any kind of regulations are passed before they end. It will be interesting to see what judgments are made for who will get their money back, how much, and when. We will find out if the end is here or if there are more ships to sink. And now you know. I hope you enjoyed the video, and now go enjoy the rest of your day. I'll see you next time.